Why hurricane-stricken Jamaica can't access $150 million in natural disaster insurance. Despite the devastation caused by Hurricane Beryl, Jamaica cannot tap into catastrophe bond funds. The reason lies in the specific trigger conditions. The required air pressure level for a payout was not exceeded. Consequently, bondholders are not obligated to pay out. Catastrophe bonds, or CAT bonds, are high-yield debt instruments designed to provide insurance companies with funds in the event of major disasters like hurricanes or earthquakes. Issued by insurance or reinsurance companies, CAT bonds serve as a risk management tool. This is how CAT bonds work. An insurance company, or a special-purpose vehicle set up by the company, issues the bonds to investors. The proceeds are held in a collateral account and invested in low-risk securities. The bonds are linked to specific catastrophic events. These triggers can be based on parameters like the magnitude and location of the disaster, the total insured losses, or the event's severity. If the specified event occurs and meets the criteria, the principal and interest payments to investors are either partially or fully forfeited, allowing the insurance company to cover claims. If no trigger event occurs, investors receive regular interest payments and get their principal back at maturity. CAT bonds offer higher interest rates than traditional bonds to compensate for the risk. They help insurance companies transfer risk to the capital markets, diversifying their exposure. Investors can enjoy attractive returns, especially in a low-interest rate environment. CAT bonds can be traded in the secondary market, providing liquidity. Investors risk losing their principal if the trigger event occurs. The accuracy of models predicting catastrophic events impacts the pricing and risk assessment of CAT bonds. Interest rate fluctuations can affect the value of CAT bonds in the secondary market. Despite the catastrophic impact of Hurricane Beryl, investors in Jamaica's $150 million CAT bond are not required to pay out due to specific terms. According to an advisory from Switzerland-based Plenum Investments, the air pressure during the hurricane did not meet the minimum threshold required for a payout. The CAT bonds were structured to pay investors 7% above the U.S. Treasury rate. The World Bank noted that the asset provides catastrophe insurance for 4 hurricane seasons and has attracted 15 global investors. Jamaica must now rely on its $1.6 billion disaster safety net to cover damage costs, while its sovereign bonds remain intact. Climate disasters often fail to trigger CAT bond payouts. For instance, despite over 20 disasters in the U.S. last year, the Swiss Re Global CAT Bond Total Return Index reached its highest one-year return in 2 decades at 19.69%. Jamaica's CAT bonds are part of its strategy to manage the financial risk of natural disasters. The country issued its first catastrophe bond in 2021, becoming the first Caribbean country and island nation to independently sponsor such an asset. The World Bank has supported Jamaica in structuring and issuing these bonds, aiding in transferring disaster risk to the capital markets. What do you guys think about Jamaica's $150 million CAT bonds? Let us know your thoughts. Thanks for watching and see you soon.